AI-powered financial ratio analysis is a critical tool for assessing the financial health, performance, and stability of an organization. It involves the evaluation of various financial ratios, which are calculated by comparing key financial figures from a company's financial statements. These ratios provide valuable insights into different aspects of an organization's operations and financial position. Here are some common types of financial ratios used in ratio analysis to understand an organization's pulse. Pradeep K. Suri. Author and researcher. 1. Liquidity ratios. Current ratio. This ratio assesses a company's short-term liquidity and its ability to cover short-term obligations. It is calculated by dividing current assets by current liabilities. A ratio greater than 1 indicates good liquidity. Quick ratio. Acid test ratio. This ratio is a more stringent measure of short-term liquidity as it excludes inventory from current assets. It is calculated by dividing quick assets, current assets excluding inventory, by current liabilities. 2. Profitability ratios. Gross profit margin. This ratio measures the profitability of a company's core operations by calculating the percentage of sales revenue that remains after deducting the cost of goods sold, COGS. Net profit margin. This ratio assesses a company's overall profitability by calculating the percentage of sales revenue that remains as net profit after all expenses, including taxes and interest. Return on assets. ROA evaluates how efficiently a company uses its assets to generate profit. It is calculated by dividing net income by average total assets. Return on equity. ROE measures the return earned by shareholders on their equity investment in the company. It is calculated by dividing net income by average shareholders' equity. 3. Efficiency ratios. Inventory turnover. This ratio assesses how efficiently a company manages its inventory by measuring how many times inventory is sold and replaced during a specific period. Accounts receivable turnover. It measures how quickly a company collects payments from customers by calculating the number of times accounts receivable are collected during a period. 4. Debt management ratios. Debt to equity ratio. This ratio evaluates the proportion of a company's financing that comes from debt compared to equity. It is calculated by dividing total debt by shareholders' equity. Interest coverage ratio. This ratio gauges a company's ability to meet interest payments on its debt by dividing earnings before interest and taxes, EBIT, by interest expenses. 5. Market ratios. Price to earnings, P/E, ratio. This ratio reflects how the market values a company's shares relative to its earnings per share, EPS. A high P/E ratio may indicate optimism about future growth. Price to sales, P/S, ratio. It measures how the market values a company's shares relative to its sales revenue. It can be useful for assessing growth prospects. 6. Solvency ratios. Debt ratio. This ratio assesses the extent to which an organization is leveraged by comparing total debt to total assets. A higher ratio may indicate higher financial risk. These are just a few examples of the many financial ratios used in ratio analysis. By examining these ratios and interpreting their trends over time, analysts and stakeholders can gain a deeper understanding of an organization's financial condition and make informed decisions regarding investments, lending, or business strategies. AI-powered financial ratio analysis is a data-driven approach that leverages artificial intelligence, AI, and machine learning, ML, techniques to gain deeper insights into an organization's financial health and performance. It involves the use of AI algorithms to analyze and interpret financial ratios, as well as other relevant financial data, to understand the organization's pulse or financial condition. Here's how AI-powered financial ratio analysis works. 1. Data collection and integration. Gather financial data from various sources, including income statements, balance sheets, and cash flow statements. Integrate external data sources, such as market data, economic indicators, and industry benchmarks, to provide context for the analysis. 2. Data pre-processing. Clean and pre-process the data to handle missing values, outliers, and inconsistencies. Normalize or standardize the data to ensure that all variables are on a consistent scale. 3. Feature engineering. Create relevant features or transformations from the financial data, such as growth rates, industry-specific indicators, or financial ratios, example current ratio, debt-to-equity ratio. 4. AI model selection. Choose appropriate AI and ML models for the analysis, such as regression models, decision trees, neural networks, or ensemble methods, depending on the complexity of the problem and the available data. 5. Training and prediction. Train the AI models on historical financial data to learn patterns and relationships. Use the trained models to make predictions or estimates based on the input financial data. 6. Interpretation and insights. AI-powered models can provide insights into the financial health of the organization by identifying trends, anomalies, and relationships among financial ratios and other variables. Interpret the model outputs to understand the organization's strengths, weaknesses, and potential areas for improvement. 7. Visualization and reporting. Create visualizations and reports that communicate the findings and insights in a clear and actionable manner to stakeholders. 8. Continuous monitoring. Implement a monitoring system that continually updates the analysis as new financial data becomes available. Use AI models for ongoing monitoring and early detection of financial risks or opportunities. 9. Scenario analysis. AI can simulate different scenarios to assess the impact of various financial decisions or external factors on the organization's financial health. 10. Predictive analytics. Use AI-powered forecasting models to predict future financial ratios and performance metrics, helping organizations plan for the future. AI-powered financial ratio analysis goes beyond traditional manual analysis by automating the process, handling large volumes of data, and uncovering complex relationships that might be challenging to detect through manual methods alone. It provides organizations with a more comprehensive and data-driven understanding of their financial position, allowing for better decision-making and risk management. Thank you.